According to Atingi-Ego, the deputy governor of the Bank of Uganda, the economy has registered some growth as anticipated since February, when the last Monetary Policy Committee meeting was held. He noted that inflation has reduced from 9.2% to 9.0%, which is in line with the projections made earlier, with the economic activity influenced by the high-frequency indicators and moderation in growth reflected by the tight monetary and fiscal policies.
The Monetary Policy Committee, MPC, maintained the central bank rate CBR at 10%. The economy has broadly evolved in line with our expectations at the February 2023 MPC meeting. The March 2023 data from the Uganda Bureau of Statistics indicated that annual headline and core inflation dropped to 9% and 7.6% in March 2023 from 9.2% and 7.8% in February 2023, respectively. Economic growth remains on a recovery path, averaging 6.8% in the first two quarters of the financial year 2022/23, and this was supported by a stronger recovery in services and agricultural output. However, the quarterly economic growth for quarter two of financial year 22/23 dropped to 4.4% from the 9.2% recorded in the first quarter of financial year 2022/23 due to a decline in industrial output and a moderation in the services output growth.
The economy is still facing challenges, such as a heavy debt burden, which is leading to a contradiction between fiscal operations and budget projections. This has resulted into financial instability, a decrease in the external financial gap, high interest rates that affect the cost of living.
Fiscal deficit is much lower than what had been projected before. I think the difference between what had been projected and what came out is around 1.5 trillion or so. Now, and that is in spite of the increase in debt servicing. You are absolutely right, yes, there was high interest payment because yields rose, the yields on government securities rose, and therefore requiring more money to service the debt. But overall, what the government did in the under fiscal consolidation is that it had to cut some other expenses and then pay obviously the interest component.
The banking sector is not only well capitalized, but also manifests substantial liquidity, making it capable of absorbing any potential interest rate shocks and continuing to provide credit to the economy. The strength of the banking sector is likely to boost the overall resilience of the economy.
There is no bank that holds more than 25% of its assets in government securities. So even a proposed increase in interest rates would not cause a shock to significantly erode their liquidity or their capital. So from that point, in terms of their resilience to interest rate shocks, the banks in Uganda, all without exception, are actually resilient to that. Now, if the issues that happen with the global banks, would that in fact impact the banking sector in Uganda? Not entirely. There was initial scare, but right now, if you even look at the share prices for some of these banks that were having a bit of a hiccup, to use your words, they've restored back their share prices.
The Monetary Policy Committee projects economic growth in the 5.5 to 6.0% range for the financial year 2022-2023. The shilling is also expected to face pressure due to the increased external financing requirements. This, combined with the lower export to import prices and the slower export volume growth, is predicted to result in a current account deficit of 7.4% of the GDP over the next 3 years, which will hinder economic growth. Martha Nimsima, Smart 24 TV, Business Today.